Welcome to the Techno Fundamental Report for March the 13th. Our old friend Jesse Livermore, there's a time to buy, there's a time to sell, and there's a time to go fishing. If you can't sleep at night because of your stock market position, then you have gone too far. If this is the case, then sell your position down to the sleeping level. Use defense. You sometimes have to use defense. If you really think about it, it's like a train's coming at you 70 miles an hour. Now, does it make sense to stay on the track and walk down the track? Or does it make more sense to step to the side, let the train pass, and then you can always get back on the track? Back in World War I, it was trench warfare. And they had like 500 miles of trenches on both sides of the border. Now, there was areas between the trenches that was called no man's land, and it was about a 25-foot stretch of property. And there would be times where you just shouldn't go to no man's land because the odds of getting shot were pretty high. So it's like I kind of feel like right now we are in no man's land. Now, I did want to mention the Somm rule, which is Claudia Somm. She was a former economist with the Federal Reserve, came up with this indicator, has had a remarkable record. It has called every recession going back to 1960. Well, it has given the recession signal, so we need to keep an eye on the unemployment rate because that has a lot to do with the calculation. The February unemployment came in a little bit better than expected at 4.1, whereas we were at 4%. A little bit higher unemployment rate. Peak of perception. A lot of times with stocks, and you got to remember, the stock is not the company. The stock is determined by an auction process. So when everybody's in the auction house, we have what we call a peak of perception. Now, if we look at NVIDIA as an example, now also we have a thing also that we do called recency bias, which means we look at recent happenings, we make conclusions, and then you can make a bad investment decision. So if we look at NVIDIA, we all know that it is super popular, everybody talks about it. Now, I started getting nervous about this stock 6-8 months ago when I went to a restaurant and I had a waiter come up to me and just talk my ear off about NVIDIA. Now, this was a guy that usually didn't buy stocks, okay? So it's kind of like the old Joe Kennedy story, where the shoeshine boy's giving him stock tips. So I've been kind of worried about this particular stock because not only did I have a waiter come to my hygienist, I was in the dentist chair, and she was talking all about NVIDIA, and it just seems like everywhere I've gone, there have been people that don't normally buy stocks are somewhat excited about NVIDIA because it's in the media and it's popular. But has it reached its peak of perception? Well, let's just take a look at something. Since it peaked last June, let's see here, last June. I don't have June on here. But anyway, since it's peaked, it has reported quarterly earnings growth of 152%, 103%, and 71%, decelerating a bit. But analysts expect the year ahead to see growth of about 52%. Despite that, and despite what was a very bullish growth stock environment, the stock really couldn't truly break out in the fall and today. It's about 20% lower than it was 9 months ago. Perception has faded. After a huge run, even those businesses remain in good shape. So it's just a question of peak perception. Now, if we look at an example of peak perception of the past, I can remember in the year 2000, now this is Cisco. This was the hot stock in the dot-com era. Now, I was at a friend's fishing camp around here, and there was a young man cutting the grass. And he came up to me and said, "Mr. Anderson, I know you deal in the stock market. My dad tells me all you need to do and invest in is Crisco systems." So again, I started to get that feeling that maybe this is a bubble. Maybe it's going to pop. Now, the other thing to be aware of is something called a dead cat bounce. We'll talk a little bit more about this. But in other words, you have a stock peak, come down and then gets a dead cat bounce. And then we start going down again, down, 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 down. So you need to be aware of the fact that when stocks drop a whole lot, you can get a dead cat bounce, which would be somewhat deceptive. Now, another thing I was wanting you to be aware of is something called overhead supply. This is an area of overhead supply. So let's go back to NVIDIA. Just look at NVIDIA real quick. You've got a lot of people that bought this stock around 140, 150. So the stock now is down to about 110, 115. These people want their money back. So every time the stock tries to rally, you're going to run into what we call overhead supply. You got an overhead supply of sellers. So when you look at this particular example here, they simply say thousands of investors shared the same thing, and that what produces overhead supply. And that's what produces it, is when everybody's thinking the same thing and it's all bullish. As the stock gets closer to its prior highs, selling picks up as more investors reach their get me out of this mess price target. So it's an overhead supply issue that we're going to be dealing with here due to the drop in the market. Now, I wanted to talk a little bit about the follow-through day. We talked last week about the follow-through day, and I'm going to give you an example here. Back in 1903, Teddy Roosevelt was president. He had just been elected. And the Dow Jones Industrial Average marked a low that was 40% lower than it was the day Roosevelt took office. Now, what's interesting about this graph is that we got the follow-through day right here. Now, there was a severe recession. The market was down, and then we got what we call a follow-through day. And what's interesting about it is that the recession ended here. So the market is a discounting machine. So it was discounting a recession or the end of the recession right here. So follow-through days are important. Now, I'll give you another example. Now, what we're trying to do is we're trying to avoid the head fake. It's like football. There's a skill that a football player can have where he can jostle his body in such a way to fool whoever's trying to tackle him. Now, this is the S&P now. Excuse me, this is S&P back in 1998. I'm sorry about that. We had a nice rally here, and then the market started to tank. So most people were saying, hey, here's the low, and you got this rally in here, which was a dead cat bounce. And then you got the real drop. It came down substantially. Again, another head fake. But we came down again here. So we came down, and what you got to have with the follow-through day is got to be meaningful. It's got to be a lot of volume coming in on the buy side because it's telling you the institutions are coming into this thing. Now remember, 80 to 90% of the volume on the exchanges is mutual funds like T. Rowe Price, Vanguard, Schwab. All these big institutional investors control about 80 to 90% of the trading volume. In other words, it's not your Aunt Sue buying 100 shares for her club. But anyway, you can see the head fakes here. And so we didn't get a follow-through day in here. We didn't get a follow-through day in here, but we got one right here. So then the market really took off. We had a fantastic move after that point. Now, I wanted to take a minute real quick. We're all concerned about the politics and the tariffs and all that's going on here. I just thought it was interesting to see the correlation to what's going on today with Trump with Ronald Reagan. Reagan came in 1980. But the market didn't take off until like mid-82. And so it took him a while to reconfigure the economy, if that's what happened. I mean, it may be just an economic cycle. But, we'd had a severe recession, coming out of Jimmy Carter's stagflation, high interest rates, high unemployment. So Reagan had to rebuild and reconfigure the economy. But once he got it going, we really got going. We got going for about 16 years. It was a pretty good period. So let's take a minute and look at where we are today and kind of discuss the follow-through day. You can see here with the NASDAQ, we're in a definite downtrend. So, cardinal rule number one, never buy stocks when the market is in a downtrend because the odds are increasingly stacked against you. So we made a low yesterday. No, this is actually on Tuesday. Now, back, a Friday or so ago, I thought this was the low. But then, we get the rally, but then it breaks to a fresh low. Then we break to another low. Now we broke to another low. So we start the count here. Because the follow-through day, you want to wait at least 3 to 4 days from this low to determine if it's the low. Because, you may have this low here and think it's the low, and then you turn around and make a fresh low. So the NASDAQ, we start the count here. So that would be 1-2 days that we've got a rally attempt underway. Now, if we get to Friday, which will be 4 days, and we're having a substantial rally attempt, now it doesn't have to be 4 days. In the case with Teddy Roosevelt's administration, it was 16 days before we got, the bottom was made, and 16 days later you get the follow-through day. Now, so you want to monitor the S&P and the NASDAQ on follow-through days because they're broad in indexes. You can see here we made the low in the S&P, and so 1, 2, just like the NASDAQ, we're trying to get to that fourth day where we get a follow-through day. Now, on a follow-through day, you want to be up at least 1.5%, 2% on that day, and you want exceptionally high volume, way above average. So we just have to be patient and wait for that. Now, I wanted to mention the aggression index. I've started to do the calculation on a daily basis because it's been so dramatic. Now, remember, we're measuring technology stocks versus toothpaste, consumer staples, NASDAQ versus it's a ratio. Well, you can see here back in the bear market of 22, you got a serious breakdown in this relationship, in this ratio. Well, we're getting it again here today. So it's just telling you, if you're in the trenches, stay in the trenches. Don't go to no man's land right now. Is basically the message. Interest rates, we want to keep an eye on interest rates. Now, they're kind of ticking up a little bit, and the power index, which we use, when it's above zero, that's not good because it means that interest rates have gone up 19% over the last 125 trading days. So interest rates have continued to climb, and if this gets down below zero or improves dramatically, it could be discounting that the Fed's going to cut. But so far, it doesn't look that way. The primary trend is now broken. Here's your 200-day on the S&P. Here's your 200-day on the NASDAQ. Both of these moving averages are getting broken in a meaningful way. Now, I will mention my trend line index or indicator that I mentioned last week is now in its second week of being under the 35-week moving average. Now, that'll be determined. If we don't rally by Friday, I think we're going to be still in for some more damage or some bad market. I'm not really sure, but we really need to see a rally between here and Friday. So if you have any questions, please let me know. Thank you very much.